Hey guys, welcome to our channel. Today's topic is about foreign exchange reserves. This article from the Hindu paper of Delhi edition appears on page number 15 dated on 13th June. The context of the news article is that the foreign exchange reserves exceeds $500 billion for the first time. It's a good news for the government, RBI and the economy as a whole at the time of disruption caused by the pandemic. These are the important points from the article. Data about the foreign exchange reserves will be released by the Reserve Bank of India. It stated that India's Forex Reserves surged by $8.2 billion to $500 billion. This increase in reserves is due to the increase in foreign currency assets. That is, we have four components in foreign exchange reserves. Among those, there is a huge rise in foreign currency assets which contribute to overall increase in the value. What is Forex Reserves? The word reserves means the amount that kept aside from the profit or retained earnings to meet the future needs, which is considered as assets. Similarly, foreign exchange reserves are the assets held by Reserve Bank of India, that is central bank, in foreign currencies. These assets includes currencies of various countries, gold, bonds and the government securities. These are the four components of foreign exchange reserve. Or in another way, these are the four different forms by which reserves are maintained by RBI. They are foreign currency assets, gold stock of RBI, special drawing rights, that is SDR holdings of government in IMF, reserve tranche or portion in International Monetary Fund IMF. I will explain in detail about each of these components in the next video to make it very clear. I have sourced this image directly from the Reserve Bank of India website. Look at the highlighted red box. It shows the value of four components in the total value. If you observe it, it is arranged in a decreasing order with the highest contribution from foreign currency assets to the least contribution from reserve position in IMF. There may be a chance in the examination to ask about the increasing or decreasing order among the components of foreign exchange reserves. Now let's see about the legal frameworks with respect to the maintenance of the reserves. As you know, Reserve Bank of India is a sole authority in managing of foreign reserves. It has a legal backing under Reserve Bank of India Act 1934, which provides for the deployment of different reserves. Now we are going to see about the reason for the rise in Forex reserves. The first reason is rise in investment from foreign portfolio investors in Indian stocks and the foreign direct investments. If you see in the first half of March month, there is a huge withdrawal of foreign portfolios due to the negative sentiment because of the pandemic. But in the recent weeks, the foreigners have bought stocks worth $2.75 billion in the India's equities market on the expectation that the economy may recover faster than expected as the government gradually started lifting the lockdown. There is also a huge foreign direct investment in the Reliance Industries subsidiary Jio platform, which helps boosting the reserves. There is no need to go in detail about different investment in the economy. I have mentioned here only to explain it clearly. Next reason is appreciation of non-dollar major currencies. As we learned, currencies of various countries are kept in the foreign currency assets. However, value of these currencies are expressed in terms of US dollar. In the recent months, dollar has depreciated, which led to the appreciation of various other currencies. Therefore, based on the increase or decrease of non-dollar currencies, the value of foreign currency assets will be deferred. Next reason is falling crude oil price. As we all know, there is a less demand for crude oil due to the lockdown, which helps in less spending on crude oil from the reserve, as India imports around 70% of crude from the world countries. Next reason is RBI intervention in the foreign exchange market. That is, RBI will buy the dollars from the foreign market based on the strengthening of the rupee. Since over a year, RBI is buying a dollar from the market, which helps in shoring up its forex reserve. Next, we are going to see about the significance of reserve. With the present reserve, India can meet a import cover up to 14 months. Import cover is a measure of number of months of import that can be covered with the available forex reserve. Strengthening of rupee against dollar. If there is any depreciation of the rupee, these reserve will help RBI in countering the depreciation by selling the dollar in the market. Next thing is it gives a confidence to the market and the investor. Therefore, we can expect the increase in inflow of the foreign direct investment and portfolio investments. It also helps the government and the RBI in meeting the external debt obligation. These are the top 6 countries with respect to the maintenance of total reserve. China is in first position with around $3,100 billion. It is followed by the Japan. India is in third position among the world countries, followed by Saudi Arabia, Hong Kong, Russia. I have mentioned here few questions asked in the UPSC prelims examination in the previous years related to this topic. Which of the following best describe the term import cover sometimes seen in the news? Here 4 statement is given, you have to choose one among them as an answer to the question. Next question is, which one of the following group of item is included in India's foreign exchange reserve? You can find the answer for these 2 questions from the video. Mention your answers in the comment section. That's all for the day. Like, share and subscribe our channel. See you tomorrow. Thank you.